A stock market rebound has helped to rekindle global IPO activity after some turbulent months for investors. Some private companies hoping to go public are looking to get deals done before the summer. Erik Hirsch joins us now. He's co-chief executive officer of Hamilton Lane. Thanks for coming in.
My pleasure. Nice to be here.
How exactly are tariffs delaying or holding up IPOs?
I think it's uncertainty in general. I think if you're thinking about pricing a deal, whether that's an IPO or whether that's an acquisition, you're looking for calm. You want the water to be calm, and trying to jump into water that's churning and frenzied, you sort of say, well, I'm going to wait for it maybe to calm down. And so I think all of these uncertainties, whether it's the tariffs, whether it's geopolitical pieces, are just creating some uncertainty. But we're starting to see some green shoots. So you're starting to see the IPO window open up a bit for certain sectors, and that seems to be a little bit encouraging.
Okay, we'll talk about that in a second, but the companies that do need that liquidity and were thinking they were going to maybe do their IPO in January, February, what do they do? Are they in a jam?
They're in a jam, but I think what you're seeing is the private markets right now have a tremendous amount of capital. Yeah. So you can stay private forever. There used to be a time when your only way out, if you got to a certain size, was you had to be public. I think those days are now long behind us. There's enough capital into the system to finance companies of various shapes and sizes forever if they want to choose to stay private. Frankly, it's one of the reasons why we're not seeing a rise of public companies in general across the public markets around the globe. The number of public companies today is actually down from where it was in the 80s or even the early 90s. People don't want to necessarily be public, and that's a change that has nothing to do with what's happening right now in the economy or what's happening politically. That's simply just a change of philosophy of sometimes being private is an easier enterprise to run.
Do you think there was a specific trigger to that?
More regulation, more expense, I think more short-term nature of investors. Again, if you're running a business that's trying to think about growth over years, trying to be a public company where if your shareholders are very laser focused on what you're doing for me today or tomorrow, makes it really hard as an executive to make great long-term choices. So I think if you can be private for some people, ironic as the public company CEO that I'm saying this, but if you can be private, I think for some people, you need to find other reasons to be public other than just capital or liquidity.
So I know some markets are struggling to get the IPOs. London is one example that has been given. What's Canada's atmosphere like?
Well, I think what's going to happen in the U.S. right now is that we're about to make a lot of other countries more attractive because people are looking for other homes, other alternatives, as they are concerned about what's happening in the U.S. around tax structure, tariff structure, et cetera. So I think we as a country are about to give away a bunch of business into other locations until our uncertainty comes to a bit of a rest.
Okay, so what needs to be done about that? Obviously, we're so affected by what happens in the U.S. There's only some of that we can shield, but are there other things we could be doing to sort of limit what the knock-on effect is or to make the market more attractive?
If you look at why the U.S. exchanges have really continued to grow and have become sort of the destination, it's because of just the sheer amount of capital that's flowing through them. The other markets are going to need to attract more capital back into those exchanges to make them increasingly attractive to companies as a venue for them to go public. Right now, the U.S. has really two big advantages: brand and sheer amount of capital. And so that's going to take a little bit of time for that to sort of shift or erode, but I think that's what people are going to need to focus on.
You mentioned green shoots, and some of them are beginning to think they can get closer to an IPO. I'm wondering, is that sector specific? Is that what you're seeing?
We've seen some. We certainly have seen some things around crypto and cryptocurrency related. So is that shocking given sort of the dynamic in the market? I don't think so. Bitcoin on a tear. You certainly have a U.S. government that's signaling right now very friendly crypto posturing. And so I don't think it's surprising that you're seeing companies now take advantage of those positive kind of wind at the back mindsets. What you're also seeing is some trophy assets, businesses that people believe are tariff immune, tariff resilient. And again, there's really pent-up demand on the sidelines of capital that's just looking for places to invest. And so I don't think that's surprising either.
Why do they want to do this before the summer? Do things just quiet down in the summer? People aren't paying attention?
I think it's both. I think you always see some summer seasonality. I think July and August, you start to see holidays and vacation schedules. Hard to get a road show, even if the road shows are now more virtual. Hard to get investor attention. I think everyone starts to take a little bit of time off. I think this year will be no exception. I think people are tired. I think there's just been so much volatility and chaos and uncertainty that I think everyone's looking forward to a little bit of a break. So I wouldn't be surprised to see a typical summer slowdown.
Yeah, tuning out. Let me ask you about how the tariffs are impacting private equity markets.
So I think here, this is one of the advantages. One of the advantages of being small, private equity finances small companies. And so small companies don't have global supply chains and they're not stretched across multiple geographies. So right now, I would say the direct tariff impact is minimal, and I don't expect that to become more significant. I think the bigger concern for private equity is what's happening to the consumer. So right now, consumer, you see it, consumer sentiment coming down. You're seeing sort of classic consumer spending patterns become a little bit more negative, rising credit card delinquencies, rising auto delinquencies. None of that feels great. So we're not immune, nor is the rest of the economy, from a softening consumer. But right now, we are pretty walled off from actual tariff impact.
Got it. Erik Hirsch, good of you to come in. Thanks very much for your time.